Hi. So in this video, what we're going to do, this is going to be about, it's going to be a review of present value and net present value and how to calculate those kind of things, how to set up a template for doing present value, net present value calculations. NPV, right? NPV is the gold standard of financial analyst tools, right? This is the gold standard of analytics tools for finance. So this is the one you really need to know. You can use this for making decisions for anything you want to do, whether to lease or buy a house, or lease or buy a car, whether to rent things, whether to buy things, anything in your life, anything in your business, any type of project, any type of income producing asset, stocks, bonds, you can value using NPV. So this is really important. I just want to make sure you really to hammer that point home, because this is where this whole course centers around, really. So how do we do NPV? Well, what we have to come up with some cash flows, some stream of income, income stream into the future, pull that back to present value, and then the N in NPV is net present value. Take away whatever the costs are and see if the present value of that stream of cash flows into the future is greater or less than the costs, right? That's what we're trying to do. So I'll even put that up here. Is the cost greater than or less than, right, the cash flows, the future income stream, right? So the dollars, into the future, pulled back to in present value, pulled back into present value. So that's what we're trying to do. So how do we set that up? Well, say if you have a company or whatever the income producing asset is or project, first we have an income statement, right? Just a simple one, right? We're going to start with an income statement, and that is what is an income statement? What are the three parts of it? You're right. Revenue minus expenses equals net income, right? Now, as we go through, we'll understand this as we go through and we talk about in accrual accounting. And if you don't understand accrual accounting, go back and take my accounting course. It'll go through all that and make you understand what happens when we do accrual. So we do the matching principle. So we're matching revenues and expenses when they happen, not when the cash comes in, right? We're not doing cash accounting, we're doing accrual accounting. And that's an important thing. Everybody asks, do you do cash accounting or accrual accounting? You should really know the answer to that question and always say, just do accrual because it's the most accurate. So, but the problem is with accrual, with revenues, we have accounts payable, right, in here. And in expenses, we might have accounts receivable and some other things that are non-cash expenses, right, or non-cash revenue. So net income can be inflated or deflated by these accounts receivables, accounts payable, and the other accrual accounts that get created when you do accrual accounting. So what do we have to do to get from net income to cash, right? Well, that's what the cash flow statement's for, right? We go through that. So the cash flow statement is going to be down here, right? And so what do? The cash flow statement starts with net income. That's the top line. The bottom line of the income statement is the top line of the cash flow statement, right? So then cash flow is the add backs and takeaways, that the adjustments that are made in the cash flow statement fall into three categories. And they are operations, and then investment, and then finance, right? So operations is going to be plus or minus, like accounts receivable, accounts payable, that kind of stuff. That's what happens in your operations that impact this. Investment, and then you have a number here, right? And then investment is what do you invest into the company that you're going to put on your balance sheet, right, as an asset. Say if you have investments in different types of machinery, you're going to buy a new plant, a new factory, a new bunch of trucks, or whatever it's going to be, that's going to help you to enhance your income producing capacities or your expense reduction capacities in the future, right? Both of those things work to make money fall to the bottom line, right? You can increase revenues, increase sales, or you can decrease expenses. And capital investments will do both of those. it's investments because it's money that goes out the door that's not in expenses, right? If you buy a factory, you don't expense that in 1 year. You might depreciate it over 10 or 15, 20 years, the useful life of the asset. So then there's going to be some pluses and minuses here, depending on what we invest in, right? And then pluses or minuses in financing. If you do a financing in a company, if you bring in, say you sell stock or you take a loan, that's not revenue. That shows up down here. It comes into the company as money, but it doesn't impact the income statement. So we make those adjustments, right? And then we have our cash number. And that's the number that we're going to use into the future here each year, say 1 year, 2 years, 3 years, 4 years, 5 years. Doesn't make too much sense to go out past 5 years, right? Because really, how accurate can your crystal ball be? And then usually what we do is we add a terminal value out here, right? And that sort of compensates or acknowledges that the company doesn't, or whatever, doesn't end after that amount of time. Say if you have a rental house or something, you don't just get rent for 5 years, you'll get rent for 20, 25, 50 years, whatever, right? So you have to have some kind of terminal value that calculates what this is going forward into the infinite future, right? We just don't know how long that is. And I'll show you what that number is too and how that's basically calculated. Okay, so we have these numbers here. And now we're going to look at going into the future with them, right? So let's say, and then you have year 0, right? That's right now. So what do you have to invest or what do you have to purchase to start getting these cash flows in the subsequent years, right? So let's say in the first year we're going to get 1,000, right? Let's say that's enough. I'm going to make these numbers round. And by the way, you want to have, and that's this number is basically after all of this stuff gets done, here's the free cash flow number. And that's what we're doing. It's called free cash flow. Now, what does free cash flow mean? That means the money that a company has available that's not obligated to other things. So that free cash flow is basically just these two things in here. And you can refine it. There's a number of different ways to do it, but just to keep it simple, right? So what happens, the add backs and takeaways from operations, and then the investment, because that's the investment is the money you need to give to the company, put in the company or put into whatever you're doing, into the project or the asset to make it run efficiently, right? So these two things, that money's called for. The financings don't really come into account on that. That gives you your free cash flow money. That's the money that's available for the company to discretionary, do whatever it wants with it. And that's what we can value to get the value of the company, right? So say in the first year, it's 1,000. And then the next year, it goes up to 1,500, say. And we're doing really well. In the third year, it's going to be 2,000. And in the fourth year, 2,500. And in the fifth year, it goes up to, let's say, 3,500. What the heck? We had a really great year. We're starting to really catch on. The company's growing and booming like that. And then what we'll say is the terminal value is 3,500 and into the future. Now we have to start talking about the next most important thing, right? The next important thing, which is the discount rate. What is the rate that we're going to discount these cash flows on to accommodate for interest rates, for risk, right? How risky are these assets? Some companies might be, it's pretty sure the company's been around for 20 years. This is going to sort of grow like this. Other companies might be brand new. You don't really know. There's more risk that these numbers out here might not be as accurate as we'd like them to be. They could be more, but they could also be quite a bit less. So in those numbers, we want to discount them more at a higher interest rate, right? So the discount rate is something that then we want to go through the iterations to calculate that discount rate, right? And that's what we're going to apply to this to pull all these numbers back to present value. Present value is going to be what's happening right now in year 0, right? So how do we do that? Well, think about this because we've talked about this. This is a review, so you should know this, right? So basically what it is, it's the cash flows, right? The formula for the present value is the cash flows divided by 1 plus the discount rate, right? That DR, just calling it R here. and then to the exponent of the year in which we're doing it, right? So we're going to multiply this, square it or cube it or whatever by the year, right? It's the exponent. So what's this going to be then? It's going to be this over 1 plus the discount rate. And let's pick a discount rate now just so we have a number in our heads, right? Now let's say the discount rate is, we're going to go with 22%, right? That's what we calculated, that the cost of capital, the risk premiums, all those kind of things that are embedded in this number. Now this number, you know, that's something that's interpretative. When you talk about these kind of valuing these deals and telling someone else, a partner, a boss or whatever, investors, why this is a good project to pursue, you can tell them what your assumptions are going into both these projections and that discount rate. And then they can either agree with them or argue with them or whatever, and then, but everything is transparent. You can see what's being done, right? So it's going to be that times 0.22 in this case. And in this case, it's going to be to the first power, right? Then it's going to be, this time it's going to be this same number to the second power. And in this time, it's going to be that number to the third power. And these are just added up, right? We're adding these guys up. This time it's going to be what? To the fourth power. Same argument in here each time. 1.22, right? Because that's 1 plus 0.22 in each case, right? And then here in this last one, going to be the same thing. It's going to be 1.22 to the fifth power. Now, if we change the interest rate or a discount rate, then we plug in a different number here. And I'm going to show you in the next video, we're going to come back. I'm going to set this up. This is going to be a problem for you to solve. And then I'll go through and we'll set this up in a spreadsheet, in Excel, and actually show you how this works. So that stay tuned for that next video. So now we have all these, plus we're going to put a terminal value, right? And the terminal value is going to be another number also in year 5, and that's going to be that 3,500. Now, when you have a income stream in perpetuity going on forever, right? Then the value of that is whatever that income stream is divided by your discount rate. So for one going into perpetuity, I like to, sometimes I pick 10%, 15%, whatever. In this case, let's pick 15%, right? 15, and that has to go also to the fifth power, right? It's going to be 1 plus that. So that will discount this number back at a different discount rate than this. I'm picking 15% for the terminal value discount rate, right? Okay, so now we have all these numbers, and what happens is now we're just pulling all these numbers back to a present value, right? Now, that's what I want you to solve. And it's a big stream of numbers, right? So you want to solve this in Excel. So set this up in Excel, and we'll come back and talk about that. Now, that's the present value, right? That's the present value of all these cash flows. Now we have that number, the PV. Now, we're looking for NPV, right? So that's net. So we have to net out the cost of this. So say if you were building an apartment building or something, you'd have, here's the rents, after the free cash flow, because you have to have money to invest in, painting and carpet every time somebody moves out. All those kind of things would be in here, or in expenses. You have your free cash flow. That's what would be available to investors, right? To you as you're doing this project, and to your partners and your investors. So that's going to be this present value. Now the cost. The cost may be, this is how much it's going to cost to build this thing, or this is how much it's going to cost to buy this income producing asset. So let's say in this case, we got these all these kind of numbers here, and then we're going to say that the cost is going to be $5,000, right? So, and this could be in millions of dollars or thousands of dollars or whatever. This could be a big project. You're just adding zeros at that point, right? So we could actually call this 5 and 1 and 1.5 if we wanted, instead of 1,000, 2,000, but it just gives you the idea, right? So what I'm saying is these numbers can scale to whatever you need to for whatever project size it is. So then what we're going to do is we're going to take this PV minus the cost, right? The present value minus the cost equals that. and that's going to equal the net present value, right? So when we get this number for all these guys minus the 5,000, right? So we know what the cost is. It's 5,000. So it would be whatever PV is minus 5,000 equals NPV. And basically, if this number is positive, it's a good project to do. If it's a negative number, then you don't do that project, right? Because that means the cost is more than the present value of the future income streams. So there you have it. That's how this works. That's how you set it up. That's how conceptually you think about these things. This is the way people value stocks. You may not think about this in this way, but a stock on the market, right? A stock market is basically an auction, and they're just bidding and asking for prices, right? Somebody says, I'll sell it for this. Somebody says, I'll buy it for this. And then if they come close enough together, they strike a deal, and that exchange gets made. Well, everybody that's selling or buying stocks intuitively is doing this whole calculation and saying, yep, I think, say Apple, right? That their prices are going to go up. There's a little bit of risk for this or that reason, or Tesla or whatever company, Google, and so here it is. And then so that number is going to be whatever. In a stock, then you divide it by how many shares are outstanding, right? And you'd say, okay, and the stock costs $50 to buy, and my present value calculations say that share of stock is worth $65 doing all this. Then if it's worth $65 and you got to pay $50 for it, would you pay $50 to get $65? Yes, right? That's a good deal. If you do all this stuff and it's like $30 and it's $50 to buy, go find another investment, right? So that is what's happening with, it's just an example of how this is embedded. This is what analysts do when they're giving a stock prediction of whether it's a good buy or if it's time to sell or whatever. So just an idea. You can do this with rental properties. Do it with a lot of different things, right? With anything that's an income producing asset. So there you go. The next video is going to be, so take the time to go through and structure this up, come up with your answer, right? And then in the next video, I'll go through it and we'll discuss what the answer is and all, and then that should help to cement this in your mind, this whole process. This is the key. If you can do this kind of calculation and understand conceptually this kind of stuff, you are going to be head and shoulders above most of the people that you'll compete against in your career. And you'll be able to make super smart decisions for yourself, your family, and for your company.